Good morning, everybody. Welcome to the Silent Wealth Management video blog. It is Wednesday, December 3rd, and I'm a little bit under the weather, so please excuse me. But markets took a big hit yesterday. We were down about 1% across the board, and we were really struggling pretty much for the whole day. And then we had the shooting in San Bernardino, California, which is a tragedy. Obviously, the markets got concerned whether it is an act of terror. Still, we don't know, but for me, reading. It sounds like it could be something. It may not be a big ISIS scenario, but certainly it looks like there's something going on there. So we'll know more later today, but certainly that puts a damper on stocks for the short term. Also this morning, ECB leader Mario Draghi is speaking about the European banks, and they're saying that they will continue quantitative easing, which is lowering of interest rates because their economy is still struggling. And I give this scenario a lot. Europe is where we were 2-3 years ago when our Fed had to lower interest rates, had to add money, had to buy back bonds to keep our markets fluid. So what did our markets do during that time? Well, our stocks went up. I think that Europe is probably, again, 3 years behind us. So I think there's some upside in Europe. And today the markets are down 2% in Europe. So there could be some opportunity there as well. And we have our ideas of what we do when we own Europe. Now, I like international investing. And I think most everyone, if suitable, needs to have some international markets in their portfolios. However, it's not just worldwide, and I don't like the emerging markets right now, which is more third world. I like developed, and I like Europe. So that's an interesting play. So that's something we can take a look at going forward. Also, Janet Yellen is speaking, of course, our Fed president, and she's going to justify why the Fed could potentially raise rates in their meeting in almost 2 weeks. So we believe there's about a 70% chance the Fed will raise rates. It'll be a quarter of a point, which is 25 basis points. Again, that's not a big deal. Yes, you'll start seeing things getting a little bit more expensive to finance, but that's okay. That just says that the Fed feels comfortable that our economy is growing at a steady pace. Okay, we're not growing at great clips, but 2% is slow but steady. The Labor Department will have a better idea because they will report, and always the first Friday of the month, the Labor Department will report jobs and how many jobs were added for the month of November. So that will come in on Friday. ADP had their report yesterday, which is a precursor, usually the couple days before the Labor Department. And they stated that we added 217,000 private sector jobs, which is better than expected. So that's the good news. Also, there's a lot going on, and it's all going to be market moving. OPEC is meeting. And these guys are arm wrestling over, Iran getting back in the market because our administration signed such a sweet deal for them. So they want to get back in the market. They want the Saudis to cut production. The Saudis don't want to cut production because they're not going to cut unless everybody else cuts, including us, okay, in the States and our shales. So needless to say, if the Iranians bring in more oil, the Saudis choose not to cut production. That gives you a flood of oil and could keep prices down around this $40 a barrel level. However, the Saudis are saying they'll stabilize things next year. So I think oil is really, really cheap right here in the energy sector. So let me give you my top sectors of what I like right now. And this is what we're looking to move our portfolios into in their weightings. Now, every portfolio is well diversified. We own a little bit of the sectors that we like a lot. There's some sectors we don't want to own, so we're not owning them. But I really think that in a rising interest rate environment, technology is going to do very well. So we're looking at technology. Financials, one of my favorite sectors right now. I still think we need to own energy, healthcare. Now, there's a couple other things I like, a little bit of staples and so forth. We want to get out of anything bond-oriented that is long-term. Anything over 10 years, folks, take a look at your bond portfolios. You may have a mutual fund that says the XYZ income fund. That is probably a bond fund. And if you look at the duration of the bonds and they're 10 years or more, that's something you probably need to get out of, okay, because that will hurt you. As rates go higher, bond prices go lower. And I can explain that to you. Anyway, that's all we have for today. Feel free to contact us if you have any questions. And the cruises are coming back, by the way. I'll be getting those next week. So that'll be great. I still encourage you to share my video. Thank you very much. Share it to your friends, and if you need some help with anything, give us a call at our office. You can email me. You can contact us through Facebook, And I hope everybody has a fantastic rest of the week. I'm Lee Seiler. Thanks for joining me.